They were willing to invest all this money to do that. And they actually got the number to do it, which I think is completely outrageous to spend your time on doing that.
I can see the whole wide world with these two eyes, and I can be whoever I wanna be, 'cause it's my life.
Hi, thanks for tuning in for another episode of Ask Spurrell CPA. Today, as the Edmonton Business Consultant, we're talking about business plans, products, services, and margin. So again, as the Edmonton Business Consultant, we're talking about business plan, products, services, and margins. Tyson, how you doing?
Good.
Yeah.
Good Monday morning.
Right on. So have you seen some of these business plan, products, services, and margins?
Yeah, a few now.
Yeah.
Did one recently.
Have you seen how we tend to make them maybe simpler than a lot of other people that are planning on too many variables, and you really need to simplify the variables?
Yeah, you want to break it down to the simplest way because it makes you understand it and it makes the business owner understand it.
Right on, yeah. So the quote that we have here today, the Benjamin Franklin quote when it comes to planning, any type of planning, in this case business planning, it says, if you fail to plan, you are planning to fail. If you fail to plan, you are planning to fail. And Palo Alto has told us that business owners who complete a business plan, even a bad business plan, are 50% more likely to grow their revenue than business owners that don't complete the plan. And of course, revenue growth is the most challenging thing about running a business normally. And the story that we have here are business plans normally attempt to make projections on too many variables. And this added unnecessary complexity, it just increases the amount of mistakes that are made on the financial projections, making it more likely that this business owner is going to run out of cash, which is problem number two of a business. So, we really have to work to simplify that. And so, Tyson, what are the questions that these business owners should be asking?
Yeah, the first one is, how many revenue streams or price points do you normally project on?
So I tend to, use 3 or fewer. I'm using like 1 to 3, and a lot of times when business owners come in, they think like, 1 to 3, how are you ever going to get it on 1 to 3? But the more variables that you have on the plan, the more things, the items on the menu that you're trying to project on, the more likely you are to make mistakes.
Okay. Do you arrive at these revenue streams by grouping similar products and services?
Yeah, I mean, you can group these similar products or services. Let's take a doctor, for example. A doctor has, maybe 1,000 things that they can bill the patient for.
Yeah.
So from a simple checkup at $20 a visit to, a really comprehensive treatment plan that's $20,000. And, it blows their mind when I tell them that we're going to boil that down into one number, patient visits. And we have that average. Every time a patient walks through the door, on average, we bill them this. Sometimes it's $20, sometimes it's $20,000, but the average time someone walks through the door is this. And that's what we do. We group those products and services together that have the same margins, that same percentage of margin. Some things might need to be different. For example, if you have a service component of your business, we'll group all those services together, but sometimes you have an inventory component of your business, those margins will be different, so we'll group all the inventory items together, and we'll just look through the business and normally group everything into no more than 3 revenue streams for simplistic and reliable planning.
Okay. Why should small businesses not make projections for every item on the menu?
There's a couple of reasons. It will intrinsically make the projections less reliable. So let's take a business. I always use the restaurant business for this one because I think it's easy for people to understand. And imagine if that small restaurant wanted to figure out their exact margin and projections on onion rings. They'd have to go through the trouble of figuring, how much grease they use for the onion rings versus the French fries, how many onions they use for the onion rings versus the garnish for the steak. It's a very time-intensive task for the average restaurant to go through that. And let's just say they were willing to invest all this money to do that. And they actually got the number to do it, which I think is completely outrageous to spend your time on doing that if you're a small restaurant business. But let's just say they did do it. As a small business, they don't have enough data points for that number to be reliable. They're not A&W. They're not selling millions of orders of onion rings every year. So there's no, guarantee that 487 orders that they sold last year is going to be sold again next year. There's too much of a degree of chance when you don't have that many data points. So planning off of every item on the menu, so to speak, increases dramatically the cost and time that you're going to have to spend on the planning and projection process. And B, even if you go through that cost, there's a limit on the reliability of that information because we don't have enough data points as small businesses.
Do you start by describing the revenue stream?
Yeah, so the first thing, because you remember we put this thing in the executive summary, so let's kill two birds with one stone. Let's describe exactly what we're doing. What is that product or service that we're delivering? Before we even talking about price, let's just put it right in there. Give a succinct, clear description on exactly what you're doing. Revenue stream number one, revenue stream number two, revenue stream number one. We're providing dermatological services, dermatological based exams. Let's start with that. And then revenue stream number two, we're providing dermatological products. So we'll start right off with that.
Okay. Do you then describe the direct costs?
Yeah, so once we get we describe that revenue stream, then we're going to describe the actual amount of the revenue transaction. So that average price per transaction is what we're going to do. So we describe the product or service that we're doing. We give a actual, average dollar figure per transaction. Then we're going to get into the costs. What are the things that we have to do in order to provide these services? We have to, we go back to the dermatologist example, we have to hire a locum doctor or an associate doctor who gets X percentage of the billings. Or for the products that we're selling, we actually have to buy the products from third-party suppliers, and so the next part, logical part, is actually describing the direct costs, so the costs that vary directly with providing that revenue.
Then do you identify the average direct cost per transaction?
Yeah, that's the next logical step. So the first thing is we describe what we're doing, we describe the product or service, we give the average transaction price that we're going to charge the customer, then we describe the costs that are involved. What are the things that we have to buy in order to provide that product or service? And then we'll give an amount on a per transaction basis for those direct costs. That's the next logical step in the equation.
Okay. Once you have those things, do you then calculate the gross margin per transaction?
Yeah, then we get that gross margin per transaction. That's different than we're at this point, we're not talking about the gross margin per year. We're not talking about the percentage per year. We're talking about, the business on its most granular level. What is that gross margin per transaction? So think about the restaurant. Every time someone walks into the restaurant, for every visit of a patron to the restaurant, how much do we make on that visit? How much on average do we charge them? How much does it cost us to prepare the food? And how much do we have left over after those direct costs of preparing and buying the food?
Mm-hmm. Why do you identify the amount per month for transactions that take a long time? Yeah,
this can be the challenge. The restaurant example or even the dermatologist example is relatively simple because the transactions, they happen in one day. Every transaction is on 1 month. But ultimately, we're doing this in the context of a business plan. And ultimately, we want to end up with monthly cash flow, a monthly income statement, and monthly balance sheet projections. And if we have transactions that take longer than a month, now all of a sudden we have to find a different way to deal with this, or else we're going to have an impossible task when it comes to doing the projections. So what we want to think about is that average amount per month on a project. So let's say you're a general contractor and your average project size is I'm going to say it's $600,000. That's a big one. Let's go smaller. Let's say it's your average project size is $100,000, and on average, every project lasts 4 months. Rather than trying to plan on the project size, because now we have different projects starting in different months and finishing in different months, and that's really going to throw off the projections. Let's look at, for every active project, we're billing on average $25,000 a month. We have that project that's $100,000 in total price. And it's it takes 4 months, so it's $25,000 a month for 4 months. And if we identify that on a per monthly basis, we're going to save ourselves a lot of headache when it comes to then trying to make projections on that type of business.
Okay. Why is the average gross margin per revenue stream per transaction so powerful?
So if we can get that, average gross margin per transaction, it is an extremely powerful number, because this starts to tell us how much we can spend to get another customer. Whereas if we just know the aggregate gross margins, we don't know how much we can spend to get one more customer. If we can spend $100 to make the phone ring, is it worth it? In some businesses, you can't spend $100 to make the phone ring, but in some businesses, you can spend $10,000 to make the phone ring, and that's okay. So you really have to know what the gross margin is per transaction, because it's going to guide you in determining, how much you can spend, to get more work. So I think that's what we have here today. As always, please hit the like and subscribe button so we can continue to deliver you tips on how to beat the odds at business. And as always, we look forward to read any comments that you have below so we can respond back and use your input to develop future videos. Thanks very much.